Is the United States economy truly experiencing a runaway boom? Or are we just reading the headlines with rose tinted glasses? The Atlanta Federal Reserve's GDP Now model recently projected a staggering 5.1% growth rate for the fourth quarter. Think about that for a second. 5.1% is a figure you typically see in a rapidly emerging market, an economy hitting its stride, not a mature G7 economy like ours. It sounds almost unbelievable, like a statistic plucked straight from a dream. But what if this impressive headline, this seemingly undeniable proof of a booming economy, masks a much more complex reality? What if the underlying drivers of that number tell a very different, perhaps even contradictory, story about demand, about our nation's mounting debt, and about the surprising resurgence of an overlooked sector of the economy? It's a bit like looking at a beautifully wrapped present. The outside is shiny and exciting, but what's inside might be a puzzle. Today, we're not just going to glance at the wrapping paper. We are going to peel back those layers of this economic narrative, dissecting the why behind these eye-popping numbers. We'll dive deep into what's truly fueling this growth, and perhaps more importantly, reveal where discerning capital is quietly shifting its focus. This shift isn't always towards the usual tech darlings everyone has been obsessing over. We're talking about a fundamental reevaluation of value, a pivot away from the obvious towards something far more foundational. We find ourselves at a critical juncture in the economic cycle. This moment feels pregnant with possibility, yet also laced with anxiety. After a period of aggressive, almost relentless interest rate hikes by the Federal Reserve, the market, pundits, and individuals trying to plan their financial future are obsessed with identifying the next phase. Are we headed for that mythical soft landing where inflation cools without a harsh recession? Is a recession still lurking just around the corner? Or, in a twist that would surprise many, are we actually seeing a re-acceleration of growth? A second wind that defies previous predictions of doom and gloom. This is why real-time indicators, like the Atlanta Fed's GDP Now model, are under such intense scrutiny. Every tick, every revised projection is analyzed with the precision of a surgeon. It's not just data anymore. It's a crystal ball that everyone is desperate to peer into, hoping to catch a glimpse of what's coming next. Adding another layer of complexity to this intricate puzzle is the intriguing picture of corporate profitability. Aggregate net profit margins for companies within the S&P 500 are currently hovering near historical highs. And here's the kicker. Forward estimates suggest these margins could climb even further, potentially north of 14%. Think about that for a moment. This robust earnings picture, this consistent ability of American businesses to generate significant profits, is a key pillar supporting current equity valuations. It's what allows stock prices to soar and stay elevated, even when other metrics might suggest caution. It's the engine driving much of the market's optimism. However, these elevated margins also represent a remarkably high bar. It's like a high jumper who's just cleared a record-breaking height. The expectation for their next jump is immense. Any deviation from these optimistic projections, if actual earnings fall short, if costs start to erode those margins, or if consumer demand unexpectedly wanes, could trigger significant market corrections. When valuations are stretched, as many argue they are now, any crack in that foundation, any loss of support from strong earnings, can cause the entire structure to become shaky very quickly. The higher you climb, the further you have to fall, right? It's a delicate balance, a high wire act, where the smallest gust of wind could make all the difference. Let's dive into that headline-grabbing 5.1% GDP Now estimate, that number that makes everyone sit up and take notice. When you dig beneath the surface, a significant portion of this recent surge in projected economic activity isn't primarily driven by a robust acceleration in domestic consumption, the kind of widespread consumer spending that signals deep economic health. Instead, a A large contributor to this impressive figure stems from a rather sharp narrowing of the trade deficit. Specifically, we've seen a notable decrease in imports, combined with a modest but still positive increase in exports. Imagine gross domestic product, or GDP, as a measure of all the economic activity happening within our borders. When we consume goods and services produced domestically, or export them, that adds to GDP. But when we import things, buying goods and services from abroad, that's money leaving our economy. So if imports suddenly slow down or shrink, even if domestic consumption isn't growing faster, the GDP will rise more quickly. It's a mathematical boost. Less money flowing out for foreign goods automatically means a higher net contribution to our GDP from trade. This is what we call net exports, which is simply exports minus imports. If imports fall significantly, while exports hold steady or even slightly increase, that net export figure becomes less negative or even positive, providing a mechanical lift to the overall GDP number. It's a calculation, a formula at play, rather than necessarily an organic burst of internal demand. This brings us to the import paradox, a classic economic double-edged sword. While reduced imports mechanically boost GDP, making that 5.1% number look even better, it's crucial to understand what might be causing that reduction. A decline in imported goods, particularly consumer goods, can signal several things, and not all of them are rosy. For instance, it could be a sign of slowing domestic consumer demand. If people are feeling the pinch of inflation, or if their real wages aren't keeping pace with rising costs, they might simply be buying fewer things overall. And if they're buying fewer things, they're buying fewer imported things. It's a direct consequence. Alternatively, this reduction in imports could indicate ongoing inventory destocking by businesses. Remember the supply chain chaos of the pandemic? Companies ordered massive amounts of goods. Now, many find themselves with warehouses full of merchandise they need to sell off. If they're trying to clear out existing inventory, they're naturally going to order fewer new shipments from overseas. They're not restocking as aggressively as they once were, which means fewer imports. This process, while necessary for businesses to rebalance, isn't necessarily a sign of robust, forward-looking demand. It's a correction, a clearing out of the old before potentially bringing in the new. Or, perhaps most concerningly, a decline in imported goods could reflect a general weakening of real consumer spending power. This isn't just about slowing demand. It's about people having less actual purchasing power after accounting for inflation. Their dollar simply doesn't go as far. When incomes struggle to keep up with the cost of living, discretionary spending is often the first to go, and many discretionary items are imported. So while mathematically beneficial for GDP, a significant drop in imports is not necessarily the healthy, organic, consumption-driven growth everyone hopes for. It's akin to someone losing weight because they're eating less, but that less is due to financial hardship rather than a healthy dietary choice. The number on the scale goes down, but the underlying reason for the change matters immensely for long-term health. To further muddy these waters, some specific, less fundamental components can also disproportionately inflate the net export contribution. To further muddy these waters, some specific, less fundamental components can also disproportionately inflate the net export contribution. Take, for example, a surge in gold exports. Gold, while certainly a valuable commodity, often functions more as a store of value or a safe haven asset than as a typical manufactured good or consumer product that reflects ongoing industrial activity or widespread consumer demand. Large movements of gold, perhaps due to geopolitical shifts, central bank activities, or investor rebalancing, can appear as significant exports in economic data. But these movements don't necessarily reflect a robust underlying increase in domestic production or a surge in demand for American-made goods and services. It's more transactional, more financial, and less indicative of the kind of broad-based economic strength that we usually associate with a booming economy. This brings us to the elephant in the room, a topic that's often discussed in hushed tones but whose shadow looms large over every economic projection: the escalating United States national debt. We're not talking about small figures anymore. We are now grappling with over $1.47 trillion in annual interest payments alone on that debt. To put that in perspective, that's a 5% increase year over year, just for the cost of servicing the debt. This isn't money being invested in infrastructure, education, or healthcare. This is money simply being paid to lenders as interest. It's a massive outflow that grows larger each year, consuming an ever-increasing portion of the federal budget. Imagine your household budget, but a substantial and growing percentage of your income goes straight to credit card interest payments, leaving less and less for everything else you need and want. That's the scale of the challenge for the nation. This monumental debt creates an almost inescapable strategic imperative. The prevailing strategy for addressing this colossal figure isn't about absolute reduction, isn't about paying it off dollar for dollar in the traditional sense, at least not in the near term. Instead, the focus is squarely on what economists call the grow out of it strategy. This approach is centered on growing the economy, the denominator in the debt to GDP ratio, at a faster pace than the debt itself is accumulating. Think of it like this. If you have a massive loan, but your income grows much faster than your loan payments, the loan becomes a smaller and smaller burden relative to your overall financial capacity. The debt doesn't disappear, but its relative size, its weight on the economy, diminishes. This strategy carries significant implications. It implies a continued, almost relentless focus on economic expansion. To grow the economy faster than the debt, policymakers might feel pressure to sustain stimulus, to encourage spending, and to keep the economic engine running hot. By its very nature, this sustained focus on rapid economic expansion could, and likely will, sustain inflationary pressures. If the economy is always running at full throttle, demand can outstrip supply, leading to higher prices. It's a delicate balancing act. You need growth to make the debt manageable, but that growth can come with the side effect of inflation, eroding purchasing power, and creating other economic challenges. Furthermore, this dynamic of needing to grow out of debt can push up real asset prices. As people see inflation as a persistent feature of the economic landscape, they naturally seek hedges. They want to put their money into things that will retain or even increase in value faster than the rate of inflation. Real assets, such as real estate, commodities, and even certain types of stocks, become attractive. They're seen as stores of value that can protect wealth from the erosive effects of a depreciating currency. So this grow out of it strategy, while a mathematical solution to the debt problem, is not without its broader economic consequences. It shapes everything from the cost of living to investment strategies and the valuation of assets across the board. It sets the stage for a period where managing debt through growth becomes the paramount objective, influencing policy decisions and market movements. Looking ahead, prominent strategists foresee continued choppiness in the market. While January often benefits from seasonal tailwinds, such as year-end bonuses finding their way into investments, retirement fund rebalancing, and a general surge in mergers and acquisitions optimism, these are often temporary lifts. They provide a psychological boost, but underlying fundamentals continue to dictate long-term trends. As we move past these initial seasonal effects, specific forecasts point to potential corrections for the S&P 500 index, particularly in February and later in September. The NASDAQ 100, which tends to be more sensitive to growth stock valuations, could also face particular headwinds in September. What might this mean for investors? It implies that the days of simply buying broad market indexes and expecting consistent upward trajectory may be giving way to a more discerning environment. In a best-case scenario, these projected corrections could be seen as healthy pullbacks, allowing the market to digest recent gains and offering more attractive entry points for long-term investors. Such an environment would emphasize fundamental analysis, rewarding companies with strong balance sheets and clear growth strategies. It would also likely catalyze significant sector rotation, where money flows out of overvalued, perhaps highly speculative areas and into sectors that demonstrate greater resilience, clearer value, or a more direct link to the foundational economy. These selective opportunities would be ripe for those who have done their homework. However, in a worst-case scenario, these corrections could be sharper and more prolonged, potentially evolving into a broader market downturn. This could be triggered by a confluence of factors: corporate earnings falling short of already elevated expectations, inflation proving more stubborn than anticipated, or an unexpected policy shift from the Federal Reserve that signals a more restrictive monetary stance. Such a scenario would test investor resolve, emphasizing capital preservation and a more defensive portfolio posture. Valuations, particularly for companies with high growth multiples, would come under intense scrutiny, and any signs of weakness could be severely punished. Therefore, market observers might brace for continued choppiness and prepare for strategic sector rotation, understanding that agility and a focus on fundamental value will be more critical than ever. Perhaps the most surprising and significant shift in the current investment landscape is the quiet yet profound resurgence of the energy sector. For much of the past decade, with the ascendancy of technology and a growing focus on environmental, social, and governance, or ESG investing, energy was often viewed as a legacy industry, one to be phased out. Yet, as we've entered this new economic chapter, the narrative is changing dramatically. While many of the tech titans, the darlings that dominated headlines and portfolios, like Nvidia and AMD, have started the year in negative territory, some of the less glamorous but fundamentally crucial picks and shovels energy service companies have been delivering positive returns. Companies like SLB, formerly Schlumberger, and Halliburton are not just holding their own, they are demonstrating genuine strength and resilience. This isn't merely a fleeting trend tied to a temporary spike in crude prices. Instead, it reflects a deep-seated, strategic, global need for energy security and robust infrastructure that has become increasingly urgent in a volatile geopolitical climate. The world still runs on vast amounts of energy, and ensuring a stable, reliable supply is a top priority for nations worldwide. Think about the need for advanced equipment and specialized expertise to revitalize aging oil fields, to squeeze more output from existing resources that remain vital to our current energy mix. Or consider the complex engineering required to unlock new reserves in challenging environments, such as those offshore Venezuela, where deepwater drilling and sophisticated extraction technologies are absolutely indispensable. These service companies are not the ones directly extracting the oil. Rather, they are the ones providing the indispensable technology, the specialized engineering, the crucial equipment, and the deep, often proprietary expertise that make extraction possible. This positions them as beneficiaries, regardless of who is doing the drilling or what the immediate, day-to-day price of crude oil is doing. They are the enablers, the foundational support for the entire energy industry, a critical layer of infrastructure that cannot be easily replaced. Crucially, these companies often possess transferable expertise and equipment that are highly relevant to a much broader spectrum of energy infrastructure projects. This extends far beyond traditional oil and gas. Consider the growing interest in nascent nuclear power initiatives, or the development of advanced power generation technologies that are less reliant on conventional fossil fuels. The same engineering prowess, the same meticulous project management capabilities, the same heavy machinery, and the precision tools used to manage a complex oil field can frequently be adapted to build and maintain other forms of essential energy infrastructure. This positions them as critical players, not just in the ongoing story of fossil fuels, but potentially in the broader energy transition story as well. They are the practical engineers who can build the future, whatever its primary energy source may ultimately be. In a best-case scenario for these quote-unquote picks and shovels companies, global energy demand remains robust, driven by continued industrialization, population growth, and the ongoing need for reliable power. Geopolitical instability continues to prioritize energy security, leading to sustained investment in both conventional and emerging energy sources. These service companies thrive by leveraging their diverse expertise to support a wide array of energy projects, becoming indispensable partners across the entire global energy landscape. Their inherent defensive characteristics, providing essential services, combined with their growth potential in new energy frontiers, suggest they could be attractive long-term holdings, offering a crucial hedge in uncertain times. Conversely, in a worst-case scenario for the energy sector, a rapid and dramatic global pivot away from fossil fuels, coupled with unexpected, rapid technological breakthroughs in renewable energy, could significantly reduce demand for traditional energy infrastructure. This might challenge the core business model of some picks and shovels companies, requiring them to pivot even more aggressively into new areas, potentially at a slower pace than market expectations. However, even in this scenario, the fundamental need for infrastructure build-out, specialized engineering, and efficient project management would likely ensure a continued, albeit possibly reshaped, role for these foundational companies. They are the builders and maintainers of complex systems, a skill set that remains in high demand regardless of the specific energy source. In essence, this represents a defensive yet growth-oriented play, providing essential services that underpin virtually all energy production, offering a layer of insulation from the volatile swings of commodity prices and the ever-shifting winds of energy policy. As we dissect the current economic narrative, the United States economy presents a fascinating dichotomy, a two-sided coin. On one face, headline growth numbers look robust, indeed, almost astonishingly strong. But when we flip that coin and examine the other side, a closer examination reveals far more nuanced drivers, particularly in the realm of trade balances and the ongoing complex strategy of national debt management. It's a picture that requires a deep understanding, not just a casual glance. As we move further into 2026, the most crucial takeaway for any discerning observer or investor is this: do not just chase the obvious market leaders. Do not simply follow the crowd towards the same familiar names that have dominated headlines for years. Insightful capital is looking beyond the surface. It is recognizing that the foundational strength of the economy, and indeed some of the most unexpected and durable investment opportunities, might lie in the essential, often overlooked, picks and shovels companies. These are the unsung heroes that enable progress, whether it's powering our present with existing infrastructure or meticulously building our future with new, innovative energy solutions. They are the engines behind the engines. Therefore, in an economic environment characterized by both impressive headline figures and subtle underlying complexities, it is paramount to stay informed, to remain rigorously analytical, and most importantly, to always look beyond the initial headlines. The true story and the most compelling opportunities are often hidden in the depths, waiting to be discovered by those willing to dig a little deeper.